Hey, Lorne Andrews here from Dominion Lending Centers, expert financial, optimalfinance.ca. So you know what's coming. Inflation is high. You hear it on the news. Most likely in June, they're going to increase their rates again, and they're talking about doing another 0.5%. Is the sky falling? Is this crazy time? Should we be locking into a fixed term? And I'm getting calls and calls and calls, and I get it. I understand. Listen, my job here is to let you make a right decision in terms of what your mortgage is. Let's put things in perspective. Before COVID happened, things were cruising along. Real estate was going well. Not a big issue. Right now, prime is 3.2%. What was prime before COVID? Looking back, 3.95%. So basically, we're kind of getting back up to where everything was before COVID happened, where the norm was. Understand that we've been sort of had such low rates for such a long time that almost in our mindset that was the new norm, which we know is not possible. It's going to go back to where it normally should be. Yes, inflation is pushing it there a little sooner, but understand that's kind of where we are right now. So let's say 3.2% is the current prime rate right now. They give the big raise of 0.5%. So now we're at 3.7%. Still below where the norm was a couple of years ago. Making a decision to go into fixed versus variable, I get it, because people are thinking, well, if it keeps going up, what does that mean? I'm going to show you that in a minute. But also understand, and I got to reiterate, that when you are in a variable, you are protecting yourself. I always say, life is variable, mortgage should be too. Things change. If you're in a variable and you ever break that mortgage before the 5 years, it's 3 months interest penalty. So 3 months interest penalty is what you would be paying to get out of that particular mortgage. But what if I'm in a fixed? I'm with a bank or a credit union. How much would that be? You usually calculate between 4 to 5% of whatever your balance is, and that's the penalty. The difference between, say, $30,000 or $3,000, roughly, depending on the amount of your mortgage. That could be significant. And people say, well, you know what, I'm never going to break this mortgage. Just 69.7% of people break their mortgage before 5 years. Why do they break their mortgage? One is there's something that comes up, they need to refinance, they need to add a line of credit, there's renovations, things that they have to break that particular term. Marital separation is a big one. All of a sudden, things are going great. Year 3, not so much. All of a sudden, you got to break that mortgage, you're going your separate ways, and there's a penalty that you're going to be paying to do that. So we get it. We know that there's penalties. And when you hear on the news that say, hey, we recommend you lock in and everything else, just look at the source, okay? Make sure it's coming from somebody that's not connected to a bank, because banks, they work those penalties into their profits. So make sure it's unbiased. We deal with banks, credit unions, monoline lenders. These banks, they're making profits on it. So basically make sure that you get unbiased advice when it comes to whether you should lock in or not. A lot of it depends on you. It depends on your goals and where you want to get to and how soon you want to get there. Sky's not falling when these interest rates go up, and I'm going to actually explain to you what it would mean right now. If you guys look back, I had a lot of views on a fixed versus variable where I kind of compared the interest rates and everything else, but the comparisons I did, the interest rates were different back then. So let's look at a variable. I'm going to take a variable rate of 2.65%. If your variable right now is lower than 2.65, your savings or the difference between the numbers I'm about to show you is going to be even greater. If I was to lock into a 5-year fix right now, I'm going to take a typical 5-year fix from a bank, which is 4.19%. Okay, so rate 4.19 versus 2.65. So this is what we're going to do. We're going to look at year 1 to year 5. I'm going to be putting increases of up to 1.75%. Okay, so we're going to increase it from 2.65% where it is right now to 4.4% in 5 years from now in the variable. And what I'm going to be doing when I do this is basically I put in increases each year and I re-amortize everything to recalculate everything every single year. So I kind of have to manually do this to see what it would mean, because I want to see what it would be if, hey, listen, if I stay in the variable and I absorb all these rate increases, where would I be relative to if I locked into a 5-year fixed term right now? Isn't that what we're trying to figure out? Let's do it like this. Let's say, for example, we'll do year 1. We're going to start year 1 right from the beginning by increasing it from the 2.65. I'm going to increase it by the 0.5%. So we're going to start at 3.15 for the year 1. We're actually starting at a much higher rate. And again, I remind you, if your rate is lower than starting at 2.65, this is going to work even better for you. We're going to start off with 3.15 in year 1. Okay, year 2, we're going to go to 3.4%. Year 3, 3.65%. Year 4, 3.9%. and year 5, 4.4%. Okay, so it's a 1.75% increase over 5 years. So let's look at this. Total interest that I'm going to be paying over the 5 years is $83,525. This is on a $500,000 mortgage, by the way. So this is what I've done. This is the amount that we're using. The total principal that I'm going to be paying off over those 5 years is $67,113. Let's take a look. If day one I locked into that 5-year term at 4.19%. So I look at 4.19%. My total interest that I'm going to be paying is $97,460 compared to $83,525 that I would be paying in the variable. Principal on the fixed, I would be paying off $63,301 versus on the variable, I would be paying off $67,113. There's an important thing to note here. What I did, I tried to make the payments comparable. If, for example, I started off with a 5-year fixed, my payments would be $1,237 bi-weekly. If I started at the variable rate, my payments would have been $112 bi-weekly. So in year one, the difference between those is $125. In year one, I put that $125 to make the payments the same. In year two, now the interest rate's gone up. Now the difference in the payment is only $95. So I just put $95. So what I did is that each year I decreased the extra payment that would make it exactly the same. In year 4, I think it was just $33 extra. And then year 5, it was 0 because my interest rate was actually higher than it is right now with the 5-year fix, because I finish off with a higher interest rate. So again, I just want to recap here is we have 5-year fixed, 4.19, $500,000 mortgage. The amount of interest that you're going to pay over that 5 years is $97,460. Let's compare that to the variable, with the variable increasing from 2.65 to 4.4% over the 5 years. The amount of interest I'm going to be paying on that is $83,525. Within the fixed, I'm going to be paying $13,935 more interest. How about our principal payments? Let's look at the 5-year fixed. I paid $63,301 compared to the variable. When I increased from 2.65% to 4.4%, it was $67,113. A difference of $3,812 more principal paid off. By staying in the variable, factoring in 1.75% increases, I have paid off $13,935 more interest and $3,812 more off my principal. Am I ahead? Yes, I am. So what does this mean? Just understand the numbers. Again, if you can't sleep at night thinking my rates are going to go up, then hey, let's lock in. Let's make sure that you have that comfort level. It's important. But once you understand the numbers, you know how to work those numbers and how those numbers work for you, because you have to also understand that your payment distribution between principal and interest will change with your interest rate. Once you get to about 2.9%, your interest principal is pretty much the same. Keep that in mind. I hope this helps. Any questions, don't hesitate to reach out. We're here to help. Feel free to put your comments, everything down. We'd love to hear them, answer any questions that you might have, and we look forward to seeing you in our next video.